Hi everyone, welcome to FinCocktail. Today we're going to talk about saving you guys some money.
Wait, how?
Tax planning?
Yes, how could I forget? We're going to talk about today how you can save some of your hard-earned money by making some strategic investment decisions based on tax planning.
But before we get into this, let me just clarify that tax planning is absolutely legal and it's a great way for planning your finances.
So let's dive into it.
Paying taxes is an important part of your civic duties as citizens of this country. But taxes are also those monsters that eat into your earnings. To counter this, tax planning is a legitimate way to reduce your tax liability in any given financial year. You can use the benefits, deductions, and the exemptions offered by the authorities in order to plan your taxes better and reduce your tax liabilities. But you must be aware so that you don't wander into the territory of tax evasion or tax avoidance.
Okay, so the age-old question, where do you begin? How do you begin this journey of tax planning? The first thing you have to keep in mind is actually when are you doing this? Because that defines the way that you do your tax planning. The first method that some people use is the short range tax planning method. Under this, tax planning का ना एकदम last minute में सोचेंगे, trying to find ways to limit your tax liability at the end of the fiscal year. The second method is the long term tax planning method. The people who do this, ये ना बड़े planning type के लोग होते हैं, future की सोचने वाले. So what they do is they think about a financial plan at the beginning of the fiscal year, think about the tax planning then too, and then follow the year through it.
Third is permissive tax planning. Now this method basically allows you to plan your taxes under the provisions offered by the Indian taxation laws. These could be deductions, exemptions, contributions and other such benefits. Fourth is purposive tax planning. It involves using tax saver instruments with a specific purpose in mind.
Okay, so before we get right into it, let me clarify one thing. We're talking about tax planning in India as a resident citizen. And before you go any further, don't forget to like, share and subscribe to our channel for more such videos. In India, deductions are available under Section 80C through 80U of the Income Tax Act of 1961. And you can claim them as per your eligibility.
So let us take you through some of the main ones that you must focus on and apply to most of the taxpayers. Sabka favorite and the most popular Section 80C of the Income Tax Act of 1961. Under Section 80C, there is a provision to reduce up to Rs 46,800 on tax liabilities each year. This is assuming the highest slab of income tax.
Under Section 80C, there are some investment options available to you. If you invest in these options for up to 1.5 lakh rupees in a single taxable year, the entire amount is deductible. These investment options include number one, an equity mutual fund, which is the ELSS, the Equity Linked Savings Scheme, and some government schemes like the NSE, the PPF, and of course some tax saving FDs.
One of these options, which is gaining a lot of popularity, is the Equity Linked Savings Scheme, popularly known as ELSS. Now this is something which provides you capital appreciation as well as tax saving. To encourage investments in the National Pension Scheme, which is the NPS, Section 80CCD1B allows for an additional investment of up to Rs 50,000 in addition to the 1.5 lakhs under Section 80C.
Next up, Section 80D. Now under this, taxpayers are offered deductions on the premiums that they pay for their health insurance. Now you can claim different amounts according to your eligibility.
Under Section 80D, you can avail up to Rs 25,000 of premiums paid on health insurance for self, spouse and children. Up to Rs 50,000 if your parents are also covered under your health insurance plan. If either of your parents fall under the senior citizen bracket, then a maximum deduction of up to Rs 75,000 is allowed.
Then comes Section 80E. Under this, you're offered deductions on the interest paid on an education loan. These deductions can be made for up to 8 years starting from the date of repayment. But the real kicker is you can claim the entire interest amount from your taxable income.
Another thing that you can consider is the HRA or the House Rent Allowance Exemption. Here, the taxpayer can claim an exemption for the cost incurred of living in a rented property. The taxpayer is mandated to furnish the rent receipts provided by the landlord. The deductions available is the least of the following amounts: actual HRA received, or 50% of the basic salary plus dearness allowance in metro cities, 40% plus dearness allowance in non-metro cities, or total rent paid less 10% of the basic salary plus dearness allowance.
Other than what we've already covered, there are a few ways for you to save some more tax. For example, donations towards charities and other qualified organizations are exempt under the Section 80G.
Income tax planning, if performed under the framework defined by the authorities, is completely legal and it's a smart decision. So don't resort to adopting any shady techniques for tax planning. Stay away from all things shady and don't avoid taxes. तो अब कन्विंस हो गए या और बोलूं?